someone walked into a coin shop and asked one simple question: what will silver and gold do now? The man behind the counter has been selling physical metal for decades. He has watched every cycle, every crisis, every government promise that quietly became every government failure. And when he heard that question, something shifted. He did not give a calm answer. He did not reach for careful language. He did not hedge or qualify or soften what he knows. He went absolutely berserk. And everything he said in that moment of complete honesty is something that every person with savings, with a business, with a family depending on them, needs to hear. Because what is coming for gold and silver is not a market story. It is a survival story. And the expert already knows how it ends. Stay right there. Welcome to Cash Compass, the channel that finds the people who actually know and make sure you hear what they are saying. Now, before we go any further, if you are someone who has spent enough years in this world to know that the most valuable financial advice never comes from television studios or government press conferences, it comes from the person who has been standing behind a counter, buying and selling real money since before the internet existed, then this channel was built entirely for you. That subscribe button right there, think of it as asking your most trusted and most experienced friend to keep you informed every single day. The kind of friend who tells you the truth, even when the truth is uncomfortable. Go ahead and press it. The same way you would accept good advice from someone who has simply lived long enough to know. And before we begin, one simple question from us. Where in the world are you watching from right now? Drop your city, your country, right there in the comments below. Because what this expert said about gold and silver does not apply to one country, or one currency, or one economy. It applies to every person on this planet who is holding paper in a world that is rapidly remembering why metal matters. Now, let's hear what the expert said. Some questions are bigger than they appear. On the surface, they look simple. They look like the kind of question anyone might ask on an ordinary afternoon in an ordinary conversation. But underneath the surface, they carry the weight of everything that has been building quietly in the background. Every economic signal that most people have been too busy to notice, every structural warning that mainstream commentary has been too comfortable to deliver, every uncomfortable truth that serious observers of money and markets have been watching accumulate for years without a mainstream platform willing to state it plainly. The question that a viewer asked a veteran coin dealer on an ordinary business day in 2026 was one of those questions. It was not complicated. It did not require a PhD in economics to formulate or a Bloomberg terminal to contextualize. It was the question that millions of ordinary working people across the United States and around the world are quietly asking themselves as they watch their grocery bills climb, their purchasing power erode, and their confidence in the institutions that are supposed to manage these things dissolve in real time. What will gold and silver do now? The man who answered that question is not a television economist. He is not a fund manager with a carefully managed public profile and a communications team that reviews every statement before it reaches an audience. He is a coin dealer, a physical bullion dealer who has spent decades standing behind a counter, buying and selling real metal from real people in real transactions that reflect the genuine state of economic confidence in the communities he serves. His name is Tim. And the answer he gave, the full, unfiltered, decades-informed answer that he delivered when that question landed in front of him, is the reason this analysis exists. But before examining what Tim said and why it matters structurally, one must first understand the precise economic environment into which that question was asked. Because the question was not asked in a vacuum. It was asked by a viewer who had already bought 85 ounces of gold and a significant quantity of silver. That detail is important. This was not a casual inquiry from someone with no skin in the game. This was a person who had already made a significant financial commitment to precious metals and wanted to understand, from someone with genuine frontline expertise, whether that commitment was correctly timed and correctly sized for what is coming. 85 ounces of gold in 2026 is not a rounding error in a diversified portfolio. At the price levels gold has been trading, touching $5,600 per ounce in January 2026 before pulling back to approximately $4,700, 85 ounces represents a capital allocation that reflects a serious, considered, and deeply informed assessment of the monetary environment. This is not the behavior of someone who bought gold on impulse after watching a single video. This is the behavior of someone who has been reading the same signals that Tim sees every day from behind his counter and has concluded that the structural case for precious metals in 2026 is strong enough to warrant a significant and deliberate position. The word that was used to describe Tim's response to that question is the word that serious analysts should pay careful attention to. Not because it is dramatic language designed to attract viewers, but because when a man with decades of direct market experience loses his characteristic composure in answering a question about gold and silver, the composure that professional dealers cultivate precisely because emotional responses are bad for business, the loss of that composure is itself a data point. It tells any serious observer that what Tim knows, built from decades of daily transactions, daily conversations with buyers and sellers, and daily observation of how real people respond to real economic pressure, has reached a level of urgency that his professional discipline can no longer fully contain. He went absolutely berserk. And the context for why that response is the most honest and most informative answer to the stagflation question that any serious person could receive in 2026 begins with understanding what stagflation actually is, what it does to ordinary people, and why the man who sells physical gold and silver to those ordinary people every single day already knows what is coming before the economists finish writing their papers about it. The word stagflation is used frequently in financial commentary right now. But it is used, more often than not, as an abstract economic term that floats above the lived experience of the people it actually describes. Stagflation is not an abstract term. It is a specific and deeply unpleasant economic condition in which inflation, rising prices, occurs simultaneously with stagnation, slowing or contracting economic growth. It is the worst of both worlds for the ordinary household. Prices are rising, which means every dollar earned buys less than it did before. Growth is slowing, which means the opportunities to earn more dollars are shrinking at the same time. And the policy tools that central banks normally use to address one problem make the other problem worse. Cut interest rates to stimulate growth. Inflation accelerates. Raise interest rates to control inflation. Growth contracts further. The Federal Reserve in 2026 is sitting precisely in that trap. Brent crude has moved from below $75 per barrel in February to approximately $115 by late April, representing what the International Energy Agency has formally described as the largest energy supply shock in the history of the global oil market. Consumer prices are feeling that shock across every category that energy touches, which is to say every category. And economic growth indicators are softening simultaneously. This is the environment into which that viewer's question landed. And Tim, standing behind his counter, watching the line of 20 people waiting to buy physical metal stretch out the door of his shop on an ordinary business day, already knew the answer before the question finished being asked, because he had been watching that line grow for months. There is a reason why the most accurate economic forecasts in history have rarely come from the institutions that are officially responsible for making them. Not because those institutions lack intelligence or resources. The Federal Reserve employs hundreds of PhD economists. The International Monetary Fund maintains research divisions that span dozens of countries and monitor economic indicators across the entire global system. The major investment banks dedicate billions of dollars annually to research infrastructure that most independent analysts could not replicate with unlimited time and unlimited budget. And yet, consistently, reliably, and across every major economic turning point in the modern financial era, the people who saw what was coming first were not sitting in those institutions. They were sitting in positions of direct contact with the actual economy. The small business owners who noticed demand softening before the retail sales data captured it. The landlords who noticed tenants struggling before the housing statistics reflected it. The coin dealers who noticed customers arriving with a specific kind of urgency before the precious metals analysts published their quarterly demand surveys. Tim is one of those people. And what the floor of his coin shop has been telling him in 2026 is a story that the paper market has not yet fully priced. A story that begins not with macroeconomic models or institutional research frameworks, but with the simple, observable, daily reality of what physical silver and gold actually cost when a real buyer stands in front of a real dealer and completes a real transaction. The pricing conversation that emerged during Tim's video is one that most casual observers of the precious metals market would find surprising. A 10-ounce silver bar in Tim's shop in 2026 is priced at $800 even. That translates to $80 per ounce at the retail physical level. The spot price of silver on the paper market simultaneously sits at approximately $75 to $76 per ounce. The gap between those two numbers, the premium that a real buyer must pay above the paper price to obtain actual physical metal from an actual dealer, is not a minor rounding difference. It is a structural signal. Premiums in the physical precious metals market are not arbitrary. They reflect the real-world cost of sourcing, vaulting, insuring, and delivering physical metal. In normal market conditions, with adequate supply flowing smoothly through the distribution chain, premiums tend to be modest and relatively stable. But when physical demand accelerates faster than physical supply can respond, when the line outside the coin shop stretches 20 people deep and the dealer's wholesale sourcing costs are rising because every link in the supply chain is feeling the same pressure simultaneously, premiums expand. And expanding premiums at the retail physical level are one of the earliest and most reliable indicators that the paper market's pricing authority is beginning to detach from physical reality. The 2026 Eagles pricing dynamic that Tim explained during his conversation illuminates this detachment with particular clarity. 2 silver coins, both containing exactly 1 troy ounce of silver, both produced by the United States Mint to the same specifications. One dated 2025, one dated 2026. And yet they carry meaningfully different prices at the retail counter. The 2026 Eagle commands a higher premium not because it contains more silver, it contains the same amount, but because it costs the dealer more to acquire it. The wholesale cost of 2026 Eagles coming through the distribution channel is higher than the wholesale cost of 2025 Eagles because the minting costs, the distribution costs, and the dealer acquisition costs have all risen in the inflationary environment that stagflation has produced. This is stagflation made visible in a coin, the same physical asset with the same intrinsic silver content, carrying a higher price tag because every cost involved in bringing it from the mint to the counter has increased. And after December 30th, the date after which 2025 Eagles transition from current year inventory to prior year inventory, those 2025 coins will drop in price by at least $1 per ounce, while 2026 coins hold their higher premium. The pricing mechanics of a single silver coin reflect in miniature the broader pricing dynamics of an entire economy experiencing the cost escalation that stagflation produces across every category of goods and services. But the most revealing data point from the physical market floor is not the premium structure or the year-to-year Eagle pricing differential. It is the secondary market signal, embedded in the Tim Yankee rounds, that are reportedly selling on eBay for approximately $100 each. A silver round is a privately minted coin containing 1 troy ounce of silver. At a paper spot price of $75 to $76 and a retail premium that brings physical silver to approximately $80 per ounce at the dealer counter, a secondary market price of $100 for a specific round represents a collectible premium of approximately 25% above the already elevated retail physical price. That collectible premium does not exist because the round contains more silver than any other 1-ounce piece. It exists because the community that values it has assigned additional worth to the specific identity it represents: a trusted dealer, a trusted content creator, and the authentic connection between them that a mass-produced financial product can never replicate. What that collectible premium actually measures, beneath the surface of its sentimental explanation, is the degree to which trust has become a scarce commodity in the 2026 precious metals market. People are not just buying silver. They are buying silver from sources they trust, in forms they recognize, through channels that have demonstrated reliability across multiple market cycles. The willingness to pay $100 for a round that contains $80 worth of physical silver at retail is a behavioral signal about the premium that trust commands in an environment where institutional trust has been systematically eroded. And that behavioral signal connects directly to the structural picture that the institutional data has been building across the preceding parts of this analysis. 6 consecutive years of structural silver deficit, 762 million ounces of above-ground inventory permanently consumed. China absorbing 52 million ounces in a single quarter and simultaneously locking its export door. COMEX registered inventory falling 38% in months, delivery volumes doubling year over year. The Federal Reserve trapped between inflation it cannot kill and growth it cannot sustain. An energy shock that the IEA has formally described as the largest in recorded history, compounding every cost across every supply chain simultaneously. The paper market at $75 to $76 per ounce has not priced any of that. The physical market, in the premiums at Tim's counter, in the line of 20 people out the door, in the $100 eBay secondary market for trusted silver rounds, in the escalating cost of 2026 Eagles relative to their 2025 equivalents, has already begun to price it. This is what Tim sees every day from behind his counter that the paper market analysts sitting in front of their screens in New York and London are not seeing. Not because the data is unavailable to them, but because data on a screen and a line of 20 real people standing outside a real coin shop on a real Tuesday afternoon in 2026 are 2 fundamentally different categories of information. One tells you what the models say should be happening. The other tells you what is actually happening. And what is actually happening in the physical market that Tim serves every day has already delivered a verdict that the paper market has not yet had the honesty to acknowledge. The physical market is telling the truth. Part 4. The strategic warning behind the Berserk answer. When the most experienced people in the room lose their composure. Answering a question? That is the answer. There is a specific kind of knowledge that cannot be taught in a classroom. Not because the classroom lacks qualified instructors or adequate curriculum. Not because the concepts involved are too complex for formal education to contain. But because this specific category of knowledge is not conceptual in nature. It is not built from theories, models, or frameworks that can be written on a whiteboard and transmitted to a room full of students in a single semester. It is built from something that only time and direct exposure can produce. It is built from the accumulated weight of having watched the same patterns repeat across multiple cycles, across multiple decades, across multiple generations of ordinary people making the same decisions in response to the same economic pressures, and understanding with the quiet certainty that repetition eventually produces exactly what those patterns mean and exactly where they lead. Tim has that knowledge. And when a man with that knowledge goes absolutely berserk answering a question about what gold and silver will do in a stagflationary environment, the response itself, the loss of professional composure, the urgency that breaks through the measured cadence that experienced dealers cultivate precisely because emotional responses are bad for business, is not a performance. It is a pressure release. The visible expression of a gap between what that accumulated knowledge knows is coming and what the mainstream financial narrative is currently willing to acknowledge. That gap is the strategic warning, not the specific price targets, not the precise timeline, not the exact sequence of events through which the structural forces that have been documented across the preceding 3 parts of this analysis will produce their observable market effects. Those details are unknowable with precision. Any analyst who claims to know them exactly is selling certainty that the market does not offer. What is knowable, what Tim's decades of direct pattern observation knows with the confidence that only repetition can produce, is the direction. The destination. The structural outcome that every stagflationary episode in the modern financial era has produced for the physical monetary assets that exist outside the debasement mechanism. Gold and silver go up, not gradually, not smoothly, not in a straight line that allows comfortable, incremental repositioning as the move develops. They go up in the compressed, volatile, and sometimes disorderly fashion that suppressed assets always exhibit when the forces holding them below their structural value finally run out of room to operate. The convergence of forces that surrounds this particular moment in the silver and gold markets is not a collection of individually significant data points that happen to be occurring at the same time by coincidence. It is a structural collision, a meeting of independent forces, each one powerful enough on its own terms to produce significant market effects that are now operating simultaneously, compounding against each other, and pointing toward a single directional outcome with a clarity that the accumulated primary source evidence makes impossible to dismiss as speculation. The stagflationary environment is not theoretical in 2026. It is the lived daily reality of every household watching energy bills, grocery receipts, and business input costs rise while the economic opportunities available to offset those increases contract. The Federal Reserve's trapped position, unable to cut rates without reigniting inflation, unable to hold rates without accelerating the growth deceleration, is not a risk scenario being modeled for a future date. It is the current operating condition of the institution responsible for managing the monetary environment in which every dollar-denominated asset is priced. The 6-year structural deficit in the silver market is not a projection. It is a documented historical record of 6 consecutive years in which global demand has exceeded global supply, drawing down above-ground inventory to decade lows without a single year of relief. The Chinese repositioning, 52 million ounces absorbed in a single quarter, export controls implemented simultaneously to prevent that metal from returning to global markets, is not an analytical interpretation of ambiguous data. It is recorded in Chinese Customs Authority reports that any researcher can access. The COMEX vault drain registered inventory falling 38% between October 2025 and early 2026, delivery volumes doubling from 240 million ounces in 2024 to 474 million ounces in 2025. May 1st notice day approaching with 77 million ounces of registered inventory against an accelerating delivery trajectory is not a speculative thesis. It is a measurable, time-stamped, publicly available inventory record. The energy shock, Brent crude from $75 to $115, formally characterized by the International Energy Agency as the largest supply shock in the history of the global oil market, is not a background factor with marginal relevance to precious metals. It is a cost escalation event that affects every component of the silver production, refining, and distribution system simultaneously, while also driving the consumer price inflation that makes the stagflationary environment more acute and the trust calculation that drives retail precious metals demand more compelling for every household feeling its effects. The Federal Reserve leadership transition, the DOJ investigation into Jerome Powell dropped on April 24th, Kevin Warsh confirmed before the Senate Banking Committee on April 21st, a new monetary policy framework arriving at the precise moment when the physical market's resistance to paper pricing authority is at its strongest in the modern era, is not a peripheral political development with no market relevance. It is a structural change in the institutional architecture that has supported the conditions under which paper market suppression of physical precious metals pricing has been maintained. Every one of these forces is real. Every one of them is documented. Every one of them is pointing in the same direction. And every one of them is operating simultaneously in the same market at the same moment. This is what Tim knows from behind his counter, not in the language of institutional research or monetary policy analysis, in the language of the line outside his door, in the language of the premium on a 2026 Eagle versus a 2025 Eagle, in the language of a 10-ounce silver bar priced at $800 at the retail counter while the paper market prints $75, in the language of a Tim Yankee round selling for $100 on eBay, because trust has become a scarce commodity in an environment where institutional credibility has been systematically exhausted. The viewer who asked the question, the one who had already bought 85 ounces of gold and significant silver, was not asking because he was uncertain about the direction. He was asking because he wanted confirmation from someone whose knowledge is built from direct observation rather than institutional modeling. He wanted to hear from the person standing at the intersection of paper money and physical metal, watching real people make real decisions in real time, whether the commitment he had already made was correctly calibrated for what is coming. Tim's answer, delivered with the urgency and conviction that decades of direct pattern observation produces when it encounters a question it has already answered many times across many cycles, was not a price prediction. It was a pattern recognition event, a moment in which a man who has watched this movie before recognized, with complete clarity, which scene was currently playing and how the remaining scenes have always ended. For the entrepreneur watching this analysis, for the capital allocator trying to position correctly in an environment where every traditional asset class is operating under structural pressure, for the financially aware individual who has been reading the same signals that Tim sees every day and wondering whether the time for considered action has already passed. The answer that Tim gave is the same answer that every accumulated data point across the 4 parts of this analysis has been building toward. The line outside the coin shop is not getting shorter. The premiums are not contracting. The deficit is not resolving. The vault is not refilling. China is not sending the metal back. And the man who has spent decades watching these patterns unfold did not go absolutely berserk because the situation called for calm reassurance. He went absolutely berserk because he has watched this pattern before. He knows exactly where it leads. And the window for acting on that knowledge, quietly, deliberately, and before the line outside every coin shop on the planet stretches around the block, is the only thing in this entire analysis that has an expiration date.